Anybody that says we have no recession ahead has no idea of how our economic system works, or they're just completely delusional. Recessions are a part of our economic system. I'll show you. In the last 23 years, we have seen 3 once-in-a-lifetime recessions. The latest was in 2020. After the pandemic hit, we saw the stock market crash by 35% in just a matter of days. The next one was back in 2008. Then, the real estate market fell by 40 to 90% in some neighborhoods, and stocks fell by more than 50%. In 8 years prior to that, we had the dotcom crash in 2000 when internet company stocks fell by over 70%, and people said that the internet fad was finally coming to an end in 2001. See, the question isn't, are we going to see another recession? Because the United States has pretty much seen a recession every decade or so for the last century. But the better question is, what happens next when we see a recession, and how can you capitalize on it? Because smart investors love recessions. Not because they like seeing their money lost in their portfolio, but because recessions create opportunities for smart investors to go out and buy investments that everybody else is selling at a huge discounted price. But in order for you to be one of those people that can actually capitalize on a market downturn and make money from it, you have to understand the one common denominator that we've seen amongst these 3 once-in-a-lifetime recessions and crashes in the last 23 years. And the one thing that you have to understand is poop. P-O-O-P. Panic leads to overselling, leads to opportunity, leads to profit. If you understand poop, you will understand how you can actually make money when you see chaos in our economy. Every single bubble that we've seen, regardless of the asset class, whether it's real estate, whether it's cryptocurrency, whether it's stocks, whether it's tulips, follows the same pattern. First, you have an asset that people want to own. Then people start to buy this asset. As the price of this asset rises, that's when you see the fancy money managers say, ooh, the price of this asset is rising, we want to buy in as well. As then more money goes in, the price of this asset rises even higher. And that's when you start to see the complex financial derivatives gets created, because now people want to gamble and make even more profits on their bets. Now you start to see these financial complex derivatives and instruments get created, and now the price of this asset rises even higher. And then the media comes in and they talk about how high this asset price is going, and now everybody gets excited and they want to buy in, and now the price really starts to soar, and then eventually you start to see the buyers start to go away. And as the buyers start to fade away, that's when things start to shift. The price of this asset no longer continues to rise at the same speed as it was before, maybe even begins to fall. And that's what triggers the initial selling. And now as the selling starts to happen, people start to get scared. They start to panic. The price of this asset starts to fall. That's when the media comes in and they talk about how this asset is crashing. People get even more scared. They sell even more. And now the price of this asset falls drastically. And that's when you start to see some smart investors come in, and they see this as a great buying opportunity while everybody else is running away with their heads cut off because they want to get away from this asset as fast as possible. Let me show you. We all painfully remember the 2020 pandemic, but the real question is, what did you do when the pandemic hit and the stock market was crashing? Were you running away, getting scared, or were you buying during that opportunity? Because if you remember, when 2020 hit, the media kept talking about how we were going to be locked up in our homes while the markets are tanking. This was the first P, creating the panic. People saw the market sell off, they thought the economy would never recover, and they thought that we would never leave the comfort of our homes again, which then created the first O, overselling, because people wanted to get out of the market. Then, in just a matter of days, the stock market had fallen by more than 30%, which created a huge buying opportunity for some people, which then created the second O, opportunity. And finally, to top it off, the Federal Reserve Bank opened up their money printer. They unleashed a tidal wave of quantitative easing, and the stock market rallied at the fastest rate ever, which allowed some investors to profit hugely. And of course, that's the second P, profit, which is the final step in poop. Now, let me highlight this 2020 pandemic crash a little bit extra, because I saw this from a very unique lens, not just from an investor, but also as a content creator and as an entrepreneur, because I work in the financial space. I run Briefs Media. This is a media company, and we work primarily in finance. We publish a daily newsletter called Market Briefs. I actually created Market Briefs because of this 2020 pandemic. But the market started crashing, and before the market crashed, before the pandemic happened, I was making 3 videos a week. The market crashed then, the economy went upside down, and I immediately went from 5 to 7 videos a week because everything was going crazy. So now I started talking about what was happening, and I said that I was investing in the market on the way down. I said, I have no idea how bad it's going to get in the markets, but what I'm doing is I'm buying in phases on the way down. As the market's crashing, I'm coming in and buying more. And the interesting thing that happened here was I would get a flood of comments. And I know this because I read these comments. I saw this. I saw the market perception. And I'll tell you something else. On the internet, people don't feel the need to hold back how they feel, especially in the comments section on YouTube. So people were talking about how I had lost my mind for buying stocks on the way down because the whole economy was about to implode, the world was going to end, and all this crazy stuff was going to happen as if things would never recover. Because when we go through any sort of downturn, we tend to put ourselves in this like tunnel where we think things will never improve. This is a very common thing that has happened in the past, and I'll give you more examples of this, but that's what we saw in 2020. So I talked about how I was buying on the way down, but a lot of people were very openly talking about how this was one of the worst things that you could do because, well, why would you want to buy stocks in the middle of this craziness when markets are crashing? Well, the part that I did not expect, and I'm going to be very honest here, I have studied the economy and markets pretty closely. I have studied what has happened in previous recessions as well. There was no way that I could have predicted the amount and the extent of the quantitative easing and money printing that we saw happen in 2020, which was a shock to the world, but me as well. I had no idea that we would see this extent of money printing, quantitative easing, and bailouts by our central bank and our government. What did that do? That created a tidal wave of money entering our economic system, which exploded the stock market at a rate which I had no idea would happen. I talked about why I was buying on the way down. I had no idea that it was going to go up that quickly. But we've seen similar things happen, not in that quick of a time span, but it shows you this is why, number one, you have to understand what's happening, and then number two, understand how you can capitalize on it. Because if you get caught up in that first P, that panic, you're going to be the person that's overselling. And we've seen this happen again and again and again. But the people that make the most money are not the ones that are overselling or panicking. It's the ones that understand what's happening. They can stay calm and they can find the opportunity. Now, of course, if you do want to stay up to date on what's happening, when it's happening, so you don't get blindsided, that's why I created Market Briefs as a free newsletter to help you stay up to date on what's happening in the top finance and business news. Every day, my team's breaking down of what's happening in the economy, the stock market, the housing market, the global economy, and our own economy into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. We have hundreds of thousands of investors reading it every single day. It's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below. And you can also go to briefs.co/market. That's briefs.co/market. In the early 2000s, we saw a huge boom in the housing market primarily because of three things. Number one, we saw the boom of ninja loans, NINJA, which stands for no income, no job, no asset loans, which means if you don't have a job, you don't have any assets, you don't have any money, but you wanted to buy a $300,000 home, normally the banks would reject you. But you can go to the bank and say, hey, bank, I want to buy this $300,000 home. I just don't have any money or any job. Can you help me out with that? And what would the bank say? Absolutely. All you got to do is sign the dotted line right here, and we will give you that check so you can buy the home. Now, your next question might be, but I don't have any money for a down payment. I know you require a 20% down payment. Is there anything that you could do for me? And that's where banks would say, absolutely. We can help you with that because we have 0% down payment mortgages. So now, if you didn't have any money to buy a home and you didn't have an income, still no big deal because now banks would give you 100% mortgages. In fact, sometimes banks would even give you 110% loan to value mortgages, which means you wanted to go out and buy this $300,000 home. You didn't have a job, you didn't have an income, you didn't have any assets to put down as your down payment, but you had closing costs, you needed some furniture. Well, the bank might even extend you a $310,000 loan. That way you had $10,000 to cover your closing costs and your move-in costs, and now you move into the home. But then your next question might be, but what happens now if I don't have a job and I don't have any money for a down payment, but I also have a really bad credit score? I have a 600 credit score because I've been behind on my credit cards. Can I still get approved for a mortgage? And that's where banks said absolutely, because we have something called subprime mortgages. Subprime mortgages meaning a special type of loan created for somebody who doesn't have a very good credit score. So now when you couple these three things together, what happened? We had people buying homes who shouldn't have bought homes, and bankers were incentivized to sell homes to people who maybe shouldn't have afforded homes because bankers are paid on commission. Now remember, bankers are in the business of selling you mortgages. People wanted to buy homes. Who do you blame? Well, some people blame the banker, some people blame the people. At the end of the day, you have to take personal responsibility for yourself. The bank's in the business of making money. They're going to always try to sell you more. And there really doesn't play any benefit of blaming either one or the other. You have to understand what's going on. That way you can take care of yourself financially, because the bankers were doing greedy and bad things. Consumers were also buying homes that they shouldn't have bought. So there we go. We had these people buying homes who shouldn't have bought homes. People are buying homes. Bankers are making money hand over fist. And now the bubble starts to get created. And then eventually the bubble started to burst. Now the reason why the bubble burst here was because partially due to the fact that we had a lot of adjustable rate mortgages. People were buying homes without having any understanding of what they were buying, but many times they were buying these adjustable rate mortgages, meaning for the first few years of you entering this mortgage, you would get a subsidized mortgage rate, a lower mortgage payment, because you got this adjustable rate mortgage. But what people didn't understand was that 5 years into their mortgage, the interest rate you pay would adjust based off of where mortgage rates are. What bankers said was, hey, if interest rates go up and you can't afford it, don't worry. Just refinance into a cheaper interest rate mortgage or sell your home. You're going to make a lot of money, so it doesn't really matter. But no one really talked about what happens if things go wrong, because that's what happened. Interest rates went up, and now people went from paying $800 a month to $1,500 a month. And now all of a sudden, a homeowner said, wait, I don't have an additional $700 a month to continue making my mortgage payments. I'm already living paycheck to paycheck as it is. Let me go and refinance. That way I can pull my cash out and continue making my payments as it was. Well, when interest rates started to go up, home prices also started to go down because people also started selling more homes, and people were not able to refinance because they realized that they were underwater on their homes. And then when they went to try to sell their home, they couldn't sell because the home values were lower than what they bought it for. Now people were stuck. They can't afford the monthly payments. They're underwater. They don't have any equity. Now what do you do? And that's what created this huge wave of foreclosures, and that's what caused the bubble to burst. So now going into the analysis of what actually happened, the first P was the panic. We had Lehman Brothers collapse in 2008. And then Fannie Mae and Freddie Mac collapsed. And then the entire financial markets were on the brink of collapse, which brings you the first P, panic. Then people thought that the financial system here in America was going to collapse and never recover, partially due to the fact that the media kept reporting of how bad everything is. And so people sold. And then you had all these fancy financial derivatives that were also being sold, and the stock market got crushed. And then foreclosures forced people out of their homes as banks tried to sell out of the inventory as fast as possible. And that led us to the first O, overselling. The result of this overselling was that we saw stocks fall by around 50%, and we saw real estate prices fall by 40 to 90% in some neighborhoods, which created an amazing buying opportunity for some people while everybody else was running away. This brings us to the second O, which is opportunity. By 2009, the stock market bottomed, and the stock market recovered by 2012. The real estate market bottomed in 2012, and then it took a number of years for it to fully recover. But the people that took advantage of that opportunity were then able to profit because they had the patience, hopefully, to ride out now the recovery and then the growth. This is where, if I'm being completely honest, I got very lucky as an investor, because I got into investing and into my financial education journey at the bottom of the 2008 crash. I was in college and I started learning about money and investing through books. And this was when real estate prices were at rock bottom. I was making a little bit of money through a small business that I was running, but I was seeing that real estate prices were at rock bottom. I didn't know what that meant. Now, I started reading books that said I should go out and invest in real estate. So now I'm 19 years old. I'm in college. I'm studying to become a doctor. And now I have this idea to start investing in real estate. I started looking at rental properties for sale, and I'm looking at homes for $30,000. And to me, this was normal because I had never seen anything before. I had never looked at homes before. I don't know real estate investors. I've never met a real estate investor before. I didn't even know what real estate investing was. This was my first exposure to the housing market and real estate in general. So when I saw a home for $30,000, I said, this must be normal. Because again, I'm in the Metro Detroit area where home prices were hit especially hard. But $30,000 was a little bit out of my reach then because I'm 19 years old. And so I found eventually this condo that was on sale for $8,400. That was the total price of the condo. I ended up buying it for $8,000 and then I rented it out for $600. It took me a few $1,000s to get it fully renovated, maybe total cost in about $12,000. But then I was able to rent it out for $600 a month. Now, the $600 a month wasn't all of my profit. I had expenses I had needed to pay. And that's the beauty part where, oh my God, what an amazing return. The problem for me was I had no idea what I was doing. So I made every mistake possible. I had a horrible tenant. I had a horrible property manager who I don't even think was licensed as a property manager. I had a horrible contractor who told me he was licensed when he was not licensed. But it was a great learning curve. And that was how I got started. For me, I was fortunate to get started at this time when it was so cheap. But the interesting thing here was when I was getting started in real estate, I knew people around me who were way smarter than I was, who had way more money than I did, or had access to way more money than I did. And when I talked to them about investing in real estate, about what I was doing, every single person told me that I had lost my mind because real estate was causing people to lose their shirts. Now, it doesn't make sense today, but during that time, people thought that the real estate market was done for, as if nobody would ever buy a home again. Again, today, this seems like it's crazy. That doesn't make any sense. But that's what the sentiment was back in 2009, 2010, 2011, even into 2012, that nobody would want to own real estate ever again. Everybody was running away, which created opportunities for people to come back. Now, you don't need to be a rocket scientist to see how much real estate prices have grown since then, but you have to understand now the ability to go against what everybody else is doing. It was the same thing in 2020. People thought that nobody would ever spend money again. People thought that nobody would ever live in this economy again. People thought that nobody would ever buy stocks again, that the whole system was on the verge of imploding. See where we are today. You can even go back in time and look at what happened during the 2000 dot-com bubble bursting. Back in the late 1990s, the internet started to grow. We started to see more and more companies on the internet, and the valuations of dot-com companies started to grow through the roof. If you started a company and you put the word .com at the end of it in the late 1990s, you could have gone out and raised millions of dollars just because you had the name .com at the end of your company. It was that excitement and that fervor that people wanted to get involved in the next hot thing, and the money was flowing in. And then in the late 1990s into the year 2000, the money stopped flowing in. And that was when the bubble burst. In the year 2000, that was when we started to see the dot-com bankruptcies, and that's what created the first P, panic. This panic then enticed people to start selling out of their investments as markets were going lower, which pushed markets even lower, which brings us to the first O, which is overselling. Then over the course of a year, we saw internet company stocks fall by around 70% on average, which created a huge opportunity, which is the third O, for people who saw the opportunity here. And then came the final P in poop, which is profit, when people realized that the internet was not a fad. Let me read you a couple headlines from the dot-com bubble. This one was published in December of 2000, and the headline was, "Teenagers are, quote, no longer interested in this internet." And the first line of this article is, "Teenagers are logging off the internet in millions, disappointed at being unable to buy goods online and by the failure of the sites which had hoped to attract them." This headline read, "Keep on believing the internet hype," and the subheadline was, "We are abandoning the internet to go back to the real world, but how long will the backlash last?" It sounds almost like a joke today that people thought that this internet thing was completely done for, but that was the sentiment. It's that poop, that panic that leads to overselling, which leads to opportunity, which then leads to profit, because people's emotions really do drive the values of certain assets. And it might seem funny later on, but during that time when you're going through that downturn, the common majority public sentiment is that this asset, whether it's the internet, whether it's real estate, whether it's the economy, is that this asset is completely done for and that it's never going to recover. And this is where now your job as a smart investor is to see which assets are worth going into and which ones are not. And when you see this type of panic and overselling, to then look for the good investment opportunities and go in and buy. And the tricky thing here is your job as a financially educated investor now is to find those good investment opportunities, because if I'm being completely honest, sometimes you will see bad investment opportunities, like when the 2000 dot-com bubble burst. Well, guess what? Some companies went completely bankrupt, which meant if you bought those companies on the way down, you would have lost everything. Some real estate deals lost people money. Some stocks after the 2020 pandemic went bankrupt. And so if you went in buying the wrong investments, you would lose everything. This is where people get scared and you see the risk. But your job now is to do two things. Number one is to be financially educated. That way you can find a good investment from a bad investment and you can find those good assets. And then number two is be prepared, because the reality amongst all three of these and every other recession and crash in history is that the people that can actually capitalize have the ability to do so, meaning you have access to money. Because if you don't have money and you see an opportunity, it doesn't really do you any good. Or if you don't have access to capital, you can't capitalize on the opportunity. You can see the best real estate deal in the world tomorrow, but if you don't have the ability to purchase it, it doesn't do you any good. So you need the both. You need the education and then you need the opportunity together. That way now you can use these two things together. That way you can capitalize on opportunities that might come your way. And this is where now it is your job now to know how to deploy your money, how to invest your money, because you have to know the different strategies. Because what most people end up doing is they just throw their money into investments thinking that they're doing the right thing, but then wondering why they're never seeing the returns. There is a strategy to the madness. There is a way to put your money to work. That way you can actually get the best returns, and that requires you to know how can you actually invest your money. When most people start investing their money for the first time, the first question that they ask is, what stock should I buy? Or if you're being a little bit more sophisticated, you might say, should I invest in stocks or real estate? But this is the wrong question to ask. I'll show you. See, when you're investing your money, the first thing that you have to understand is what kind of investor are you? Because investing isn't just finding the right stock. It isn't just finding a good real estate deal. Investing is how do you deploy your money in a way that's going to align with your goals and in a way that's going to give you the most return. Because if you just throw your money into a stock, it might make you money, but it might also lose you money. The same stock that loses you money can make somebody else money depending on what your strategy is. And this is why you have to know your strategy first. And that's what I want to talk about right now, because the reality is the first investment decision isn't what stock or how do I invest. It's what type of strategy do you want to use as an investor? And I generally like to think about this as two different strategies. Either you can be an active investor or you can be a passive investor. When I say active investor, I don't mean being a trader. I'm not talking about trading. I don't know how to trade. I'm not a trader. That's gambling to me. I'm not talking about flipping or trading. By active investing, I mean investing in individual companies, looking for individual real estate deals to purchase yourself and operate yourself. By active investing, I mean you're actually looking for individual investments to go out and find at a good price to purchase. Passive investing is more automated, where you don't have to really worry about it. You put in the work on the front end to find a good investment, and then you set it and forget it, and that's it. And this is where the first question you have to ask yourself is, how involved do you want to be as an investor? Because some of you are weirdos like me, and you might say, yeah, you know what? I like studying financials. I like reading financial statements. I like reading cash flow statements. I like reading the income statements. I like listening to earnings calls. I like looking at real estate deals. I like figuring out how I can maximize my returns. Some of you will enjoy that. Others of you are going to say, I hate that. I don't want to spend the time doing that. I'm a busy professional. I don't have time to do that. I don't want to take on that additional work. That just seems stressful for me. I just want to set it and forget it. And that is what's going to first drive the next question, which is, how do you want to get paid? Because some of you are going to be like me, and you're going to say, I want to get paid with cash flow. I don't really care too much about the appreciation. My goal is to stack the cash flow, slowly build up this cash flow stream where right now maybe I can make $100 a month, then $200 a month, then $500 a month, then $5,000 a month. That's the type of way you might want to get paid. Others of you might say, you know what? I rather build up this nest egg. I want to build something bigger and more aggressive. That way I can pull from this nest egg in the future. And so you got to decide, would you rather get paid with cash flow or would you rather get paid with appreciation? And then once you understand these things, that's what's going to decide and help you make that decision of where you're going to invest your money. And let me start with the passive side, because I think the majority of Americans should be a passive investor. And the reason why is because most people think investing is, I'm going to go out and find the next Google or the next Amazon or the next Apple. And when the majority of people try to do that, they end up losing money. Why? Because maybe even you found a good company, maybe you don't have the psychology to hold on to your investments. When the 2000 dotcom bubble burst, the Amazon stock fell by over 90%. So if you hypothetically had invested $10,000 into Amazon before the bubble burst, that means you had to see your $10,000 go down to $9,000, to $8,000, to $6,000, down to $4,000, down to $3,000, down to $2,500, down to $1,500, down to almost $1,000, and still held on for you to see the returns of what Amazon became today. Most people don't have the psychology or the financial education to hold on to an investment through that downturn and then actually know if that investment is still a good investment or not. Amazon could have gone bankrupt, in which case if you sold out, it would have been a good decision, but they didn't. And this is where now, are you willing, number one, to have the psychology to go through the ups and the downs and the emotions and the roller coaster and not panic, not get greedy when things are high, not get emotional and sell when things are low? And then number two, do you have the time, ability, and interest to actually learn how to keep up with an investment, to learn what is this company doing, to learn how they're innovating, to study the executives of a company, to study their cash flow statements and their income statements and their balance sheets? Are you interested in doing that? You don't have to know all of it today, but you have to be willing to learn that as well, because that's what's going to allow you to accelerate your returns. Most people are just investing in random companies and then hoping that this company goes up. And sometimes it will, other times it won't. But this is where your job is now to decide what type of investor that you want to be. So if you don't want to do all that work of researching the individual companies, then the next thing is, how can you be a passive investor? And now what passive investing is from a broad level, whether it's stocks or real estate, is you're going to create a system where now every so often, every month, every 2 weeks, every week, you pick the cadence, but every so often money is going to automatically leave your checkings account and is going to be invested into an asset class. And this could be whatever you want. So for me, I'll tell you exactly what I do. I don't recommend what I do to anybody. I'm just telling you what I do. I have a passive investing system that happens in the stock market, in cryptocurrency, and into physical gold. For me, every Wednesday, and there's no secret sauce as to why I picked Wednesday. I just picked Wednesday because it's in the middle of the week. Every Wednesday, I have cash that leaves my checkings account and it gets invested into my portfolio of ETFs. I'm going to explain what that means in just a second. So it gets invested into the stock market every Wednesday for me, whether the market's up, whether the market's down, and nothing changes. In fact, the only time I might change this is if we're going through a downturn in the economy. Then maybe I'll invest more. That's it. I don't change it otherwise, whether the market's up or down. What the mistake that a lot of people make here is when you see market downturns, they stop buying. That's the time where you should be buying more, if anything. Then in the cryptocurrency space, I have a passive investing system where I buy a little bit of crypto every single day. Now, I'm not going into a lot of the smaller coins. I'm just buying mainly Bitcoin and Ethereum. Again, I understand it. I understand that it's speculative. I understand that it can go to zero, and it's a small piece of my total portfolio. Don't copy what I do, but if that's something that you want to do, you have to understand if it makes sense for your portfolio. So for me, I have a system where I'm buying a little bit of Bitcoin and Ethereum every day. And then I have a third passive investment, which is where I buy physical gold every month. Again, this is active. I'm not talking about gold certificates, paper gold, gold stocks. I'm talking about physical gold. There are platforms that will allow you to passively buy more physical gold. And then for me, every time I accumulate enough physical gold to get a physical gold bar, it gets shipped out to me. That's what I do. So now, how do you actually do this practically? Let me focus in on the stock market side of things. In the stock market, the way that I do it is I invest my money into ETFs, which are exchange traded funds. See, when you go out and you invest in the Amazon stock, you're investing in the Amazon business. You're investing in one company. If Amazon grows, you make a lot of money. If Amazon goes bankrupt, you lose everything. But if you're going to be passively investing, I'm not researching which individual companies are being invested because it's passive. So now the alternative is you can invest in a fund. There are ETFs, which is one version of them. There are index funds. There are mutual funds. Each one of these works similarly, but a little bit different at the same time. Index funds are generally passively managed, meaning they're generally an algorithm which creates a type of fund that you can invest in, which means the fees are generally lower. Mutual funds are generally actively managed, which means you generally have a money manager that's working to actively buy and sell stocks for that fund. Your fees are generally higher, but the goal with the mutual fund is to get high enough returns to justify paying the fees. Your job is to figure out what type of fund that it is that you want to invest in. ETFs are a hybrid of index funds and mutual funds where they trade just like regular stocks. Some of them are passively managed. Some of them are actively managed. I just like the flexibility that comes with ETFs. That's why I invest in them. So in my ETFs, I have a simple system where every Wednesday, money gets pulled out of my checking account and it's automatically invested. Now, what types of ETFs am I investing in? I have 4 general categories of ETFs. Number 1, my largest is my dividend portfolio of ETFs. These are funds that are primarily focused on generating cash flow for me, dividends or cash flow. Number 2 are my value ETFs. These are investing in the broader, stronger, been around long time companies, things like the S&P 500. So I have ETFs to give me exposure to that. Third, I have the innovation. This is more on the risky side, more on the speculative side. This is more like the growth side and more ups and downs side. So the smaller third one is innovation ETFs. And then the fourth one is emerging markets. These are countries and companies overseas that aren't so reliant on the United States and the United States dollar as a little bit of a hedge. So every Wednesday, money gets pulled out of my checking account and it gets distributed to this portfolio of ETFs. I have my daily cryptocurrency buys, and then I have the monthly physical gold buys. But I'm also an active investor as well. I actively invest my money into my own business, Briefs Media. I actively invest my money into physical real estate, and I actively invest my money into stocks and startups. So to give you kind of a picture of what my portfolio looks like, again, I'm going to say this one more time. I do not recommend what I do to anybody. This is just as an example for you. The bulk of my total portfolio is for cash flow. 2% of my total portfolio is physical gold. 18% is what I call speculative. And when I say speculative, what I mean is that's my cryptocurrency and that's my startups. These are my more fun investments that could go completely to zero or could grow a lot. I like it and that's why I invest in it, but I also understand that it's speculative. The other 80% is my real estate and stocks. So now when I invest in physical real estate, what I'm looking for is cash flow again. And when I invest in real estate, what I do is I'm looking for properties, single family homes, apartment complexes, doesn't really matter what it is, where I can get a 7% cash on cash return on my money. Meaning if I invest $10,000 today of my own money, then I'm going to get $700 of profit a year from my money. And this is where the common emotion is, wait, that means if I invest $100,000, I'm only making $7,000 a year in cash flow. That's not a lot of money. And you're right. The misconception about investing is that investing is going to make you rich. No, that's not how it works. You got to make money, build this money, and then take this money, use it to buy assets. That way you can continue to get paid. And that's the mindset shift that you have to make, because right now most people are just reliant on their salary. I want you to be reliant on your assets, which means you got to make money, buy the assets, have the assets produce money for you, and then use that money to live off of. It's not going to happen overnight. This is a lifetime process, but that's the goal. So when I invest in real estate, I'm looking for that type of return. That way I can build a cash flow. I'm also investing in individual companies, stocks on the stock market, but this time now it's not happening automatically. Now I'm looking for good deals. This is where if I see something like a market crash, or if I see a company get hit really hard, or if I see an undervalued company that I want to invest in, that's when I will go out and actually invest in that particular company. So it takes more time, takes more effort, takes more research. And then the companies that I have invested in, I'm keeping up with them as well. I'm looking at what are they doing on their earnings. I'm looking at how they're performing. I'm looking at their financial statements because I want to keep up with the companies that I'm invested in. And then I also invest in startups. This was something that I got into around the pandemic time. It was more of like a fun thing for me because I like entrepreneurs. I like working with entrepreneurs. I love supporting them. So this gave me an opportunity now to help support entrepreneurs financially. And I'm also fortunate where I can also help provide distribution for entrepreneurs because I have a large audience here on YouTube, and then I have Briefs Media, which also gives me distribution through my own newsletters. So I got into it in 2020, and it's interesting because when you invest in startups, it's very different than really anywhere else because you're kind of investing a little bit in the shadows. Because when you're a startup versus a public company, startups don't have to give you a lot of financial information until you ask for it, right? Public companies have to disclose quarterly how their financials are doing. They have to tell you how they think the economy or their company is going to do in the next quarter. They have to give you a bunch of intense financial statements. Startups, it's much more kind of not public information, so you have to pull some of that out. And so it's also risky because these are companies that are much smaller. And so if you're investing in startups, you have to understand that 9 out of 10 startups are statistically going to fail. But the goal is to find that 1 out of 10 company that will make up for all those losses. So it's something that I enjoy. It's not a huge piece of my portfolio, but it's something that I got into during the pandemic. So now your goal is to, number one, figure out what type of investor do you want to be. Do you want to be more on the active side or do you want to be more on the passive side? Then you got to figure out how is it that you want to get paid. Do you want to get paid more from cash flow or for appreciation? Right? I've been talking primarily about cash flow because that's what I like. But you can invest your money into stocks for appreciation. There are different types of ETFs or index funds or mutual funds that you would look at. There's different types of stocks you would look at as an active investor. So now, if you know you want to be a passive investor who wants appreciation, that's going to guide the way that you're investing your money and what you're investing in. If you want to be an active investor for cash flow, then that's going to change how you invest your money and what you're investing in. And that is then going to give you the ability to guide your investment decisions. The mistake that a lot of people make is they just give their money to a money manager and they say, hey, can you manage my money for me? And sometimes, not every time, but sometimes your money manager is going to have their financial interests higher than yours. And this is where your job is to be financially educated enough that if you have a money manager, you can ask the right questions and you can make sure that their interests are aligned with yours because you want them to make money for you before they make money for themselves. That's the key for you as an investor, is to just make guided decisions. Investing is not rocket science, but you have to be willing to get started and you have to be willing to learn. And you also got to be willing to make a mistake and take risks, because without that, you're never going to get started. And if you never get started, you're never going to learn. But this is where also you want to understand what's happening in the economy right now, because sometimes the media is just going to tell you some little piece of what's happening rather than the whole picture, which I think is something we should talk about. Is the inflation fight over? Well, there's some little known information about inflation that has really not been covered that heavily by the traditional media, which I want to talk about because what we've been hearing a lot is that inflation has fallen to the lowest levels that we've seen in a couple of years, with CPI coming down all the way to 3%. And this naturally has a lot of people wondering, is the inflation fight over? Are interest rates going to fall sometime soon? And does this mean that my grocery prices are finally going to start falling? But let's dive a little bit deeper into this because there's some interesting pieces of information that really isn't broadly covered. Now, just so we're on the same page, the Federal Reserve Bank is the central bank here in the United States, and they're the entity that's in charge of trying to bring inflation down. And one of the ways that they're trying to bring inflation down is by raising interest rates. So the reason why mortgage rates are so much higher now than a year and a half ago is because the Fed has aggressively raised interest rates. And the Federal Reserve Bank now is the entity that's closely monitoring the inflation numbers to decide what they want to do with monetary policy, meaning what are they going to do with interest rates? What else are they going to do to help stimulate or slow down the economy? Now, if you've read any headline on inflation recently, most of them have read something kind of like this. The Consumer Price Index, or CPI, which measures inflation, increased 3% from a year ago, which is the lowest level since March 2021. This is from CNBC. CPI, or the Consumer Price Index, is one measure of inflation. But the real question is that the right measure of inflation to really be paying attention to? And the answer is really, it depends who you're asking. And so if you want to understand what the Federal Reserve Bank is is going to do when it comes to inflation, you have to understand what is the Federal Reserve Bank looking at when it comes to inflation. So let's go to the Federal Reserve Bank's website. On the Federal Reserve Bank website, it says that the PCE price index, or the Personal Consumption Expenditures Index, is the Federal Reserve Bank's preferred way of measuring inflation. So now we have two different measures of inflation. We have CPI, which is also known as headline inflation, which is what a lot of media companies have been covering. And then we also have PCE, which is also known as core inflation, which is what the Federal Reserve Bank likes to look at when it comes to raising interest rates. So we know that CPI has fallen to 3% according to the reported numbers. But what about PCE, or core inflation? If we take a look at core inflation here, the latest core inflation report said that core inflation has fallen to 4.8%. And what you see is that yes, core inflation, PCE inflation, has fallen off of its highs, but its highs were 6.6%. So we are still closer to the highs of core PCE inflation than we are to the target 2% inflation. See, if you've been following this channel or if you read market briefs, you know that the Federal Reserve Bank's target inflation is 2%. Now, when CPI comes in at 3%, everyone says, oh, we're right next to our 2% target. The inflation fight is over. But the question is, which inflation numbers are you actually looking at? Because the Federal Reserve Bank isn't really looking at CPI the way that a lot of people are. The Federal Reserve Bank says publicly that they are looking at the PCE index. And the PCE index says that inflation is still at 4.8%, which is still significantly higher than 2%. And this is where that real fight on inflation is bringing this PCE index down even lower. And the PCE index is essentially you take the CPI inflation numbers and then you remove some of the volatile numbers like food and energy, and that's what brings you this core inflation number. So the Federal Reserve Bank is looking at this PCE number and they're saying, how can we bring this lower? And the balance that they have to play is, how can we bring this lower without breaking the economy? Because we've seen the effects of higher interest rates. They slow down the economy. Higher interest rates mean higher mortgage rates, which slow down the housing market. Yes, the housing market's still strong, but imagine how the housing market would be if mortgage rates were still at 3%. There's a couple different things happening right now. Number one is when people see the headline inflation number falling, a lot of people think the inflation fight is over. When people think the inflation fight is over, they assume that the economy is going to boom, and then that creates more spending and more boom in the markets, which interestingly is a tool for more inflation. See, because when people see inflation falling, what do we see happen in the markets? The markets start to boom. This is what we've seen happen in the last few inflation reports, that as inflation falls, people go out and they start putting money into the markets and they start spending again. But what is that going to do to demand? If people are spending more because they feel like inflation's falling and demand starts to rise, well, that produces more inflation. And so that's kind of the interesting first thing that you want to pay attention to, because we could be seeing more inflation due to more demand created by people's perception of inflation falling. That's the first thing that you want to pay attention to. The second thing that you want to pay attention to is the dollar, because our dollar is our currency here in the United States, which is the obvious part. But the interesting thing is, when you have high inflation, the value of the dollar goes down. When you have lower inflation, the value of the dollar should go up. But what we saw happen when the most recent inflation report came out, which said the CPI fell all the way down to 3%, the dollar actually fell. The dollar fell to some of the lowest levels that we've seen in a couple of years. And now if you think about this, why would the dollar fall, the dollar value fall, when inflation is falling? Because if inflation's falling, you'd think that trust for the dollar would be going up. And this is where now you have to kind of just put in your own guesses. Why are people or investors worried about the health of a dollar? That's why the value of the dollar is falling. Why would people be worried, or why would the dollar value fall if inflation is falling? Generally, that would happen when you see higher inflation. And maybe that's because investors are worried about the true inflation that we have. That maybe the inflation problem is not over. That maybe this inflation might be around a little bit longer. Maybe the Federal Reserve Bank will pivot a little bit earlier. If the Federal Reserve Bank pivots a little bit earlier, that would cause more inflation in the future, right? Investors make decisions not based off of what's just happening today, but based off of what they perceive in the future. And so it's interesting to see that we're seeing inflation levels fall, yet the dollar was also falling at the same time. And then on top of that, something that you want to pay attention to, especially when it comes to the dollar, because inflation, our dollar, our currency, all get tied into one another, is what are other countries doing? in regards to the dollar. Because what we've been seeing happening recently, very recently, is that the BRICS nations, Brazil, Russia, India, China, and South Africa, have been coming together to create their own currency. In fact, they just met again in June 2023 to talk about how they can create their own currency to divest themselves and diversify themselves away from the dollar. And the interesting thing is that the new currency that they want to create is likely going to be backed by gold, or at least that's what the rumor is, that they want this new currency to be backed by physical gold. So what are we seeing happen? We're still seeing high inflation. We don't know what the Federal Reserve Bank is going to do. There's a chance that the Federal Reserve Bank will pivot. If the Federal Reserve Bank pivots to save the economy, that could create more inflation. We are also starting to see a slowdown in the economy. How much? Well, we don't really know because people are still having money to spend. But then we also have these BRICS nations at the same time as kind of this icing on the top, working to create their own currency to diversify themselves away from the dollar. Now, is that a direct threat to the dollar? Most people will tell you no, but the reality is if more and more countries are trying to move away from the dollar, what does that do? It ultimately just creates less demand for the dollar. Our dollar isn't backed by any precious metal. It's not backed by anything besides the health of our government, the strength of our military, the strength of our economy. And so if we have more and more people that stop using dollars or we have less demand for dollars, that would hurt the value of dollars. And if the value of a dollar is dropping, that also can create more inflation. So this is where your job is to understand not just what's happening, but understand how you can understand this information for yourself. Because yeah, there's a lot of information out there about what's going on with inflation. You want to really understand what's going on with inflation. That way you can be an educated investor and be a prepared investor, because anytime you start to see slowdowns in inflation, what happens? People say, oh, the economy is all good. There's nothing to worry about. The fight on inflation is over. But you got to take a look at everything from a broader lens and be patient as well, because there's a lot of different things happening in different parts of the economy and different parts of the world. That way you can understand how each piece plays a part with one another. And that's why you don't want to be blindsided. So number one, you got to stay up to date on what's happening. That's where market briefs can help you. But then also number two, you want to be financially educated, learn about investing, learn about how you can find good opportunities, whether it's in stocks, whether it's in real estate, whether it's in whatever. And then number three, you want to work to be getting prepared right now, because no matter what happens, it doesn't hurt you to be prepared. Have cash put aside to protect you against an emergency, and then have cash put aside to be able to capitalize on opportunities. I've been saying this for a while now, but 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart and put that money aside. That way you can capitalize on opportunities that might be coming your way. If your goal is to truly become wealthy, and by wealthy, I mean not just driving around in a paid off Toyota Corolla, I mean having the nice things that you want, having the vacations, having the lifestyle that you want, you're not going to achieve that by just getting a 3 to 5% raise every year or by maxing out your 401k. I'll show you. Wealthy people become wealthy not because of the income